Hello traders, welcome to a new video. So in my premium Discord, we've talked a lot more about options recently. So I want to give you guys a little bit of alpha, meaning advantage of the markets. And if you think that this might be something up your alley, then go check out my premium Discord for only 15 a month. Super cheap. All right, let's dive into today's video. So a strategy that I've been using that's been working pretty well is combining the DVol with Bitcoin options. What do I mean? First of all, let's talk about DVol. Deribit just released futures contracts for volatility. What that means is that you're trading the 30-day rolling volatility futures. What that means is that if I buy this, I want there to be a lot of volatility. I want price to be going all over the place. If I short it, I want there to be just not that much volatility. That's how this works, okay? So if I short it, I want this to go down, which would be a decrease in volatility. If you look at this chart here, this is the DVol versus the price of Bitcoin. As you can see, when Bitcoin just tanks like that, DVol tends to rise. When Bitcoin just rises like crazy, DVol can rise too. DVol is going to rise and fall based on forecasted volatility. So when a move occurs, volatility typically increases, or DVol typically increases. Okay? So the strategy that I have today is just beyond simple. It's a strategy that I used to use back when I used to trade on an exchange that had 3 letters as an acronym. If you get my drift. And this strategy can be quite profitable. It's basically shorting an options contract and then using a 50% stop loss and 50% take profit. And at the same time, buying DVol. What do I mean by that? Well, when I buy DVol, basically what I'm doing is I'm in a way hedging out volatility, because if volatility increases, I make a fair amount of money. Okay. Now, if I short this put, I do not want 2 things to happen. I don't want volatility, and I also don't want price to fall. Typically, when it comes to volatility, guys, a price fall tends to create more volatility than a price rise. So hedging a short put, like what I'm about to do, is probably best done by buying volatility directly. So I'm going to show you guys how I'm going to manage that. So the first thing that I want to do is to short this put contract. This one expires in 10 hours, so I think it's actually pretty fairly priced. But first, before I short this, let's go look at the historical. As you can see here, this put gained a little bit of value, went up to a high of like 150. Had you shorted it, you would have made a lot of money. Okay. Now, it's probably going to go to 0. Its likelihood of becoming profitable is very, very low. If we look at its delta, it will actually tell us the probability. Oh, it says 20%. This is indicating that there's a 20% chance that it becomes in the money. I don't think it would really be that high, but let's go into it. So I'm going to short one contract at 0.001, and let's go. Here we go. So, account does not have enough funds, of course. How about if I do 0.5? Will it let me do that? Well, as a test, I put 0.03 Bitcoin into Deribit, but as a test, I'm just going to do 0.25, 0.3. It still doesn't want me to do that. Okay, we'll do 0.2. Deribit just is not playing ball with me. Okay, so we did sell a little bit at 0.001. As you can see, it took a lot to actually even sell this. But yeah, so I have a contract of a tiny short of 0.1. That means that my premium, meaning what I earn, would be about $2-3, which of course is not a lot, but let's go hedge that. So when it comes to hedging this with volatility, the ratio, there's not an exact ratio that you can use. I mean, there probably is, but I'm going to be doing this my own way. I think that to hedge this properly, I would probably want to do a 10-to-1. So one contract of BTC DVol, I'd $43. I'd say that's probably fair to 0.1, 10-to-1. So I'm going to buy one of those at 43. Okay. So let's click buy. And I have just bought one at 43. So what I've basically just done, guys, is I have a position on BTC DVol where I bought one at the price of 43. And then the other thing that I did was I shorted a put at 0.001. So what's going to end up happening is, let's say the price does decrease, volatility will probably increase as well, which means that I can sell my futures, my volatility futures at a higher price. So let's say that volatility increases by 2%. Then because I own one contract, I would make $2, and that would hedge out some of the loss of this. So the reason I wanted to make this video is to show you guys not just the power of you know, Deribit in general, but also to show you their new product of BTC Devol and how you can trade it. Now, the final thing that I want to do for this is to add a stop loss and a take profit, because that is part of the way that you should be doing this. Okay, let's go find out how do I make a take profit or a stop loss. Good till canceled. Request quote. Add component. I think it should be here, or I can just do it after the video to add a stop loss. Close. Oh yeah, add right here. This is the point that I want it to go to. Order form, trigger orders. Yeah, here we go. Add component. Trigger orders, and looks like I'm probably gonna have to add this on my own. But guys, basically, I found that the best way to do this is to put a stop loss. I mean, at whatever you probably think is best, but probably put a stop loss like 50% larger than this. And then that means that if the price of this goes up by like to, you know, 0.002, then I would take a loss, and then I would also sell out my volatility. Of course, this is not like a great example of exactly what I would do with a bigger account, but what I will say is there's a lot of power to the new tool of using Devol to hedge your options positions. Or you don't even have to hedge your options positions. You could just trade this outright if you think there's going to be a rise in volatility. Some reasons why volatility could increase or decrease. Typically, an increase in open interest leads to an increase in volatility. Decrease in open interest can lead to a decrease in volatility. That's one thing. Another good way to look at it is if you ever see a lot of price movement, but volatility is not really moving yet, that can be a very good time to buy Devol, to buy volatility. An example of that would be, look at all of this price rise right there, and Devol didn't really increase. It went down to like 40. This would have been a great time to have bought volatility at about 40, 41, because then it went up to like 46. And on 10x leverage, that's a very, very, very large gain on your account. So looking for a very, very strong price move and then waiting for volatility to kind of dwindle, that historically has been a very good way to trade Devol. So that's another way that you can trade Devol really quickly, or you can use it to hedge your puts. It's not a perfect hedge, but it will give you some money back if I was to lose money on this put. So with that being said, happy trading, guys. We'll see how this trade goes. And yeah, go check out Deribit's Devol, because this is the only product I'd say on the market that I really trust to directly trade volatility. Whether you're using it for speculation or for hedging, I wanted to show you guys all of this for those who know options trading and want to add a little something to their portfolio. Happy trading. See you guys next time.